Hi friends, welcome to the next session on Accounting Standard Revision Series. Two sessions till now have been completed, and accordingly we have studied some of the topics which is applicable for advanced accounting paper. I hope your studies are going very well. Today, in this particular session, let us start taking up some accounting standard topics, because now as we know that the majority syllabus of this paper is purely based on accounting standards, where revising these standards is supposed to be one of the challenges. At the same time, it's one of the very crucial thing for us. So accordingly, let us take up some of the standards in this session and start learning about it. Any doubts you find in this, please get back to me, write that in the comment section, or you can send any messages to my WhatsApp number, which have been given as a part of description to this video. Also, make sure that your focus is on the revision of the topics rather than anything else. So don't keep any distractions now. Make sure that you work on the requirement of this particular session. With this, I will be taking up 4 accounting standards in this session, starting with AS1, then AS2, then AS4 and AS5. So these 4 accounting standards will be discussed and analyzed, revised in this particular session. Make sure that you work very well on this. With this, without any further delay, let us start discussing about the topic. Happy studying. Let's start with the session.
Starting with AS1, and this talks about disclosure of accounting policies. So this is the very first accounting standard what you have, especially from exam point of view. If I have to say, yes, group 1 first accounting standard is AS1, which talks about disclosure of accounting policies. Now, what is covered in this standard? Number one concept what we need to see is about what do we mean by accounting policy. What is this accounting policy all about? For that, only two conditions comes into the picture. One, there is a principle of accounting, then there is method to apply such principle. Together, you call that as an accounting policy. So there is a principle, there is a method to apply, together accounting policy. Example, my principle is to value inventory. Fair enough. And I use FIFO method to do that, which means applying this FIFO method for valuing the inventory purpose became an accounting policy for us. In the same way, say I have foreign currency transaction, and I use RBI rates for conversion purpose. So in future, it's anyhow going to come that according to AS11, if there is any foreign currency transactions, it should be converted to reporting currency. For that, you need a rate to do that. So there is a methodology applied, which is RBI rates. The principle is to convert foreign currency into Indian currency. Now it became an accounting policy. So in these way, there will be a principle of accounting, there will be a method to apply such principle. In few of the places, other accounting standard itself will tell this is an accounting policy. If any standard instructs that it is an accounting policy, then fair enough. You have to consider that and you have to move on. But overall understanding of the policy, there has to be a principle, there has to be a method to apply such principle. Next, once we know what do we mean by an accounting policy, the next question what comes is, what is that disclosure? What is that disclosure all about, and what are supposed to come over there? The first thing when it comes to disclosure is all significant accounting policies should be disclosed. So basically, significant accounting policies are supposed to get disclosed is what AS1 going to tell us. Now, a question comes, where it is supposed to get disclosed then? It should get disclosed in notes to financial statements. So if I have to give you an example, for say a company is supposed to present their financial statement, it should do it according to Schedule 3. Over there, after the financial statements, notes is supposed to be given saying what are the significant accounting policies followed by the company. Now, AS1 does not tell only that much, that significant accounting policy should come. It adds one more. What is it? It tells that this significant accounting policy should provide true and fair view of state of affairs. So, whatever accounting policies they have, it should provide true and fair view of state of affairs of the concern. So basically, it tells us that whatever policies you adopt should provide a proper understanding of the business for any user to that manner. So that will be true and fair view. So even when an auditor is going to give any sort of report, they will check whether these books of accounts, financial statements, etc., whether they show true and fair view or not. So this is about that disclosure requirement. All significant accounting policies should be disclosed. These significant accounting policies should necessarily go with true and fair view. Now, once they talk about the disclosure aspect, they talk about there is something called as fundamental accounting assumption. Now, what do we mean by fundamental accounting assumption? It's just a continuation to the previous thing what we have learned. What did we learn? Disclose significant accounting policies. It should provide true and fair view. Now, the same standard further continues and tells us that there are certain accounting policies which are assumed to be followed. Okay, there are certain accounting policies which are assumed to be followed, which means those policies, the users feel that these things have been followed. Blindly, they believe it. So those things are called as fundamental accounting assumption. So now just think about it. What will be the impact then when it comes to fundamental accounting assumption? Impact will be of two types. One, if you have followed these fundamental accounting assumption, or if not followed. Okay, if followed, if not followed. So the point is, if at all the user have assumed that certain policies has been followed, and if it is actually followed, then no disclosure is needed. However, if the user assumed that you have followed, but it is not actually followed, then automatically disclosure is compulsory. So basically, if fundamental accounting assumptions are followed, don't disclose. If not followed, then disclose it off. Now, what are those fundamental accounting assumptions we have? The fundamental accounting assumption are of three types. The first one is going concern. Okay, quick understanding about this concepts now. Number one, it is basically the concern is going to be there for foreseeable future. Okay, the concern is going to exist for a foreseeable future. There is no need for the business to close up. Then, what is the impact of going concern? If going concern assumption is followed, then the financial statements are supposed to be prepared according to cost basis. If going concern assumption is not followed, then financial statements will be prepared according to realization basis. One of the important things which might be asked in your exam also is this. Okay, suppose the institute says that going concern assumption has been followed, then follow your normal methodology of doing everything according to cost. So assets are shown at cost, liability are shown at the value at which it is due to be paid. However, if going concern assumption is not followed, which means the concern might be closed in future, which means you should show your assets according to realization value, you should show your liability according to settlement value, because it is supposed to get closed in the near future. So that is the impact of going concern what you have. First fundamental accounting assumption. The second one talks about accrual. Now, under accrual mechanism, how it is going to happen, the things which are covered over there is records are maintained as and when it is considered, which means records are maintained as and when an event is occurred. So according to occurrence basis, a record is maintained for accounting purpose. So that basically means you are not going to wait. So do not wait. Not to be considered stuff is cash receipt or cash payment. So don't wait for cash receipt or cash payment. You have to do it according to occurrence, according to event. That event has occurred, pass an entry. Otherwise, don't pass it. Now, another very important element of accrual is this is a compulsory element for all the companies according to Companies Act. Companies should and must follow the accrual concept, whereby they don't have a choice for cash concepts. They have to follow the accrual basis. The final fundamental accounting assumption what we have is consistency. And according to consistency principle, it just tells us that accounting policies should be followed consistently from year to year. So whenever I need, however I need, I can't change a policy. Policy could be changed only under certain circumstances. So therefore they said whatever policy is adopted right now, try to follow it consistently from year to year basis to help, one, to follow all the records properly, two, for comparison purpose. It becomes easy for any user to go with that mindset. So these are the fundamental accounting assumptions we have: going concern, accrual, consistency. Next part of element which is set by AS1 tells us that how do you select an accounting policy. Now, what are the selection aspects of an accounting policy? Yes, major selection aspect is it should provide true and fair view. But to create an accounting policy, what are the things which you have to take care of? Number one, you have to take care of prudence. So one of the basic stuff in accounting, what does this tell? It tells that anticipated losses can be provided, but anticipated gains are not to be provided. However, when do you provide the gains then? Gains are allowed only when it is realized. What do you mean by realized? Received or a right to receive is considered. I make a credit sale, I get right to receive, then it is realized. So this is prudence. So anticipated losses can be provided in the books or should be provided in the books, but gains never. It should be done only when it is realized. Realized doesn't mean receipt. Realized basically means received or right to receive. So right to receive is established, that is more than enough. Next, the second aspect for selection is substance over form. Substance over form. Now, what does substance over form is going to tell us? It tells us that economic substance over legal form. So what is that economic substance? Economic substance basically means that how the value derivation has taken place. The best example for substance over form is your hire purchase. So if you remember hire purchase, which is again a part of your first group chapters itself, even though the vendor is the actual legal owner of the asset, since the value derivation is made by the purchaser throughout the life, it is shown as asset in the books of purchaser itself. So asset involved in the hire purchase agreement is shown in hire purchaser books. Why? Substance over form. So even though legal owner is someone, the value derivation is done by the other person. Consider that person for the purpose of accounting. So that is covered up under substance over form. So even your finance lease is also covered by the same accounting concept of substance over form. It will be shown in lessee's book instead of lesser book. So those things are going to be the impact of this particular topic. The last one is materiality. Now, what do you mean by materiality? Only material aspects are going to be disclosed. So anything you consider for an accounting policy, consider only the material aspects. Now, what do you mean by material aspect? Material aspect basically means if it fluctuates the decision of the user, it becomes material. Very important line. If it is going to fluctuate the decision of the user, it's going to become material. So only amount is not the aspect to be called something as material, even other aspects also. So for that reason they mentioned, is it going to fluctuate? If yes, then done, that is material for you. So if there is a small fraud which has taken place, say the amount is very small, but a fraud has taken place, now this is material to be disclosed to the user, because fraud is by nature one of the element which fluctuate the decision of the user. You have paid a heavy penalty, or you have paid a penalty which is not normally paid. So at that time, maybe the amount is small, but still it becomes very important to be disclosed by any concern. So this is the 3 points which is supposed to be covered. One is prudence, second is substance over form, third one is materiality. Now, after that, AS1 further continues with another topic which tells that can an accounting policy be changed? So changes in accounting policy. Now they say that it could be changed provided any one condition is satisfied. Okay, not all, any one condition, if it's satisfied, then it is more than enough. So those 3 famous conditions are: 1, allowed by statute or required by statute. Statute basically means law. Second, allowed by accounting standard or required by an accounting standard. Third one, it leads to better presentation of financial statements. So if AS comes into the picture and tells that these changes should and must be done, then there is no option, you have to do it. If company's law come and tells that you have to do it, don't have an option, then do it. But the last one is decision making, whereby management has to take a decision saying that if at all it leads to a better presentation, we will allow it to change. Otherwise, it's not allowed to be changed. So any one of these conditions should be satisfied. Otherwise, it goes against consistency, which was a fundamental accounting assumption. You should apply your you should apply your accounting policy consistently. If you don't do it, then it's a wrong aspect. So therefore, only in these circumstances accounting policy is allowed to be changed. Otherwise, a big answer will be no. Finally, if there is a changes in accounting policy, how disclosure should take place? So when there is changes in accounting policy, what type of disclosure is supposed to be given by any organization? So number 1, the impact lies only in the current year, and the impact is in the future years also. So if when there is an impact which is going to be applicable for the current year, then again it will be bifurcated into 2. Whether you can estimate on a monetary basis or there is no monetary basis. If it could be explained on monetary basis, then disclosure in terms of monetary basis is compulsory. Okay, if I have to give you an example, FIFO method has got now changed to weighted average. So if FIFO you follow, there will be a specific value to closing stock. If you convert that to weighted average, again the value will change. Now, this could be said in monetary terms. Then disclose the monetary terms. What is it changes in towards profits? How much value got changed? Every valuation could be set. Suppose if it cannot be said in monetary terms, then fact should be disclosed. Disclose the fact of that particular situation as to what had happened in a particular basis. Suppose if this going to impact the future years, then in the current year, fact to be disclosed as to how it is going to be impactful for the future. Okay, so current year impact, monetary, non-monetary, monetary, then disclose with monetary terms, non-monetary, only fact should be disclosed. For future years, tell what is going to be happening for that future year. So these are your AS1 requirement. It's a small standard, it is easily remembering point, but still you have to go through all these requirements and then you can take up a decision about this particular standard. So these are the theoretical basis of AS1. Now I will just show you a problem whereby I can tell you how to present an answer whenever an AS1 comes into the picture. I hope everybody are ready. Now let's take up one problem based on this. Okay, I'll quickly read up this question. Let's see how it could be done. ABC Limited was making provision for non-moving inventories based on number of issues for the last 12 months up to 31/3/2019. The company wants to provide during the year ending 31/3/20 based on technical evaluation. Total value of inventory 100 lakh, provision required based on 12 months issue, provision required based on technical evaluation. Does this amount to change in accounting policy? Can the company change the method of provision? This is the question which is asked. I've already written up the answer so that we can save some time. But first I will tell you how to analyze this question, what kind of sentences I need, then I will show you the answer, which is again anyhow been attached with the PDF whatever I have shared. Now, they say that according to number of issues for the last 12 months, they were creating provision for non-moving inventories. So there are non-moving inventories, which means it is going to lead you for slow profits. So for that reason, they are creating certain provisions for them. Now, what they are trying to do now is they want to change from that number of issue to technical evaluation. And they have given you the amount impact on that. So if you follow the 12-month issue, what is going to happen? If you follow technical evaluation, what is going to happen? Major question asked is, does this change in accounting policy? Can the company change? So two questions has been asked to you. Whether this is a change in accounting policy, number one. Can this change is allowed, number two. Now try to understand the impact. If it is an accounting policy, then changes are allowed only if, remember those 3 points: statute, accounting standard, better presentation. If it is not an accounting policy, then according to the situation, you either allow it or you don't allow it. Okay. So first answer whether it is an accounting policy or not. If at all whatever situation is given to you is related to an accounting policy, then change will be change in accounting policy. Apply that statute, standard, better presentation points and move on. But if it is not so, then you have to think about some other alternatives. First, whether it is accounting policy change or not. Now for that, try to understand. I will now try to tell you some logic on this. If you get the logic, then it's great. Now try to understand. So basically when it comes to accounting policy, what things we need to remember? It is, there is a principle of accounting, there is a method to apply such principle, together will be called as an accounting policy. Now, point to be understood is the principle is that I want to value non-moving inventory and the method for that is creating a provision. Okay, see, try to understand the stuff. Whenever there is non-moving inventory, you want to create a provision. So, non-moving inventory valuation became a principle for me and the method for considering the true profit is creating provision. Okay, and how do you create provision? You estimate the amount. So don't get confused. Now the 12-month issue and technical evaluation or not methods to apply principle. They are only calculation modes. Method to apply is to create a provision in the first place. So accounting policy is I have to value the non-moving inventory, and for the valuation purpose I create provision. That is the accounting policy. How do you get the provision amount? That is just an estimate. So therefore here they are only changing the calculation method. They are only changing the accounting, not policy, accounting estimate. What would have been changed in accounting policy if at all you changed the provision itself? Till now you used to create provision, from tomorrow onwards I won't create provision. Now that is change in accounting policy because you are changing the method. But here you are not changing the method, you are just changing the estimate to calculate the amount. So therefore this is change in accounting estimate. So first question they asked, does this change in accounting policy? The answer is no, this is only an estimate. There is only change in estimate, there is no change in policy. Then whether these changes are allowed, the answer is yes, because whenever there is an accounting estimate, if at all it is leading to a better mode of calculation, the change is proper. 12-month issue is one way of calculating, but if it is a technical evaluation, it's even better. You are giving more information to your users, which means that change is normally allowed. There is no problem whatsoever. But a change has taken place. User should know that you have to just give a disclosure saying that method to calculate or the amount calculation, the accounting estimate has got changed, and therefore the user should know them. So this is the analysis of the question which you have to bring it in your answer. So what is the final conclusion? No change in accounting policy because it's not an accounting policy in the first place. Changes has taken place to accounting estimate. This change is allowed because it is giving you a better mode of presentation or better way of understanding. So those things has been given in sentences now. I'll quickly read it up for you. Accounting policy refers to accounting principles and method of applying those principles in preparation and presentation of financial statements. In this case, company is creating provision for non-moving inventories. In the current year, decision for making provision was made on the basis of technical evaluation. This does not lead to change in accounting policy. The accounting policy shall be the creation of provision. Derivation of amount shall be an estimate. Estimates can be changed in case more prudent estimate is available. Therefore, in this case, the estimate of provision is allowed to be changed. This change should be disclosed by the company by way of notes to accounts. So this is the way you have to present it. First paragraph, target what they have asked. Okay, so they have asked whether it is a change in accounting policy or not. So first tell what is an accounting policy. In the middle, tell what are the cases involved. So you can quote the accounting standard. Over here, it's not directly related to AS1, it's an overall understanding. So therefore, directly it is related to AS1 is not quoted, because even AS5 also talks about accounting policies. If it is going to specifically talk about a particular standard, quote that standard. It is covered by that standard. Afterwards, give an elaboration of it. What has happened in the case? Finally, give your conclusion. This has to be the body through which you have to write an answer altogether. Okay, so if you could remember all those theory, you can automatically bring these answers over here. So that is the way in which you have to get them up. So with that, only one question I could find, and this question was in your RTP. Okay, so therefore I could pick that up and a question has been discussed altogether. So this is the way in which you have to analyze a particular standard from your exam point of view. This is our first standard. So now the same basis could be covered for the other standards also. Now, before I wrap up this accounting standard revision, as I have promised, I have told you that we will take up certain highlight points. We can use those points for remembering purpose. Number one, what do we mean by an accounting policy? Number two, what is the requirement of disclosure? Number three, what are these fundamental accounting assumptions? Number four, What should we consider whenever there is selection of accounting policy? Number 5, when changes for an accounting policy is allowed. Number 6, what should be done whenever there is disclosure for such changes? Okay, the major reason why I'm giving you like this is if you now just see one of the point, dimag ki batti jalao. Say what should be coming over there. Fundamental accounting assumption. What should come? 3 points. Going concern, consistency, accrual. Then selection. 3 points has to come. What are those? Prudence, substance over form, materiality. So once you know what is there in the standard, you would know what is there in the body. Because body would have already learnt. Only thing is what are the points which are covered up in a standard is the major issue. So that has been highlighted here. So see these points, just analyze what is there in it. And you can easily remember the entire standard. Bring that up in the sentences in the exam. This standard becomes very easy for you. Okay. So with that, AS1 will come to an end. Valuation of inventories. Now, one of the major asset for any organization is the stock what they are going to hold. So there might be your fixed assets or current assets as such. Current assets stock is one of the crucial asset what any enterprise can hold. So valuation of those stock is covered in this standard as to how these inventory are supposed to get valued. So now let's see the revision points of these one by one and let's try to summarize in an overall way. Starting with, this standard has certain exclusions. So those things are not supposed to be covered in the standard. One, it is work in progress under construction contract. So what is the major reason? The major reason being work in progress under construction contract is covered by AS7. So therefore this standard does not cover it. Second, work in progress under service contracts. So if there are any service rendering at that time, if there is any work in progress under the service contract, then again it's not covered by AS2. Then third one, if there is any financial instruments, so if you have got any shares or any other financial instruments which is hold as stock in trade, which is kept as stock in trade, then it is excluded. If it is kept as an investment, it is covered by AS13. If it is kept as stock in trade, it is excluded from AS2. It will not be covered. Fourth one, if there are any agri products, which is agricultural produce, forest produce, etc., it is again excluded. Now, what is the reason why agri produce, forest produce and all are excluded? Because these things are always valued at NRV. So there is a normal trade parlance where it is always valued at NRV and accordingly they are going to value these products. So these four items are not covered under the provisions of AS2. After this, the standard tells us the definition of inventory. Now, what do we mean by inventory in an overall way? There are certain technical words which we have to remember. So I will just bring that up now. First, these are supposed to be assets. So these are supposed to be assets which are held for. So in general, obviously inventory is an asset which is held for. First, sale in ordinary course of business. Second, in the process of production. Third, consumed in production, including maintenance supplies. If not covered by AS10. Okay, how to interpret this? Sale in ordinary course of business basically means finished goods. In the process of production basically means work in progress. Consumed in production is basically raw material. However, in the last point, when it is consumed for production, it just not includes raw material, it will include all other supplies as well, like tools, jigs, dies and all maintenance supplies, provided they are not covered by AS10. AS10 talks about fixed assets, property, plant and equipment. So this is going to talk about other than property, plant and equipment, which means maintenance supplies are used for production purpose. So that will be covered under inventory. So instead of just writing the words finished goods, work in progress, raw material, when you write any answer, when definition is involved, then make sure that you use these technical words to justify your point. Otherwise, it doesn't look good. So therefore, just make sure that you write these technical points if a definition based question is asked for you in the exam. So this is talking about finished goods, work in progress, raw material, definition mindset. Now, the next part what we need is what is required for valuation. The important point of this standard, mainly we talk about finished goods and work in progress. Point to be remembered that whenever you value inventory, finished goods are valued separately, work in progress is valued separately, and even raw material is valued separately. Now, finished goods and work in progress has got a similar valuation rules. Before I start off with the valuation rules, first you have to remember one thing. How do I get total inventory value? How we normally get is, first we get inventory value per per unit. This will be multiplied with total inventory units. So normally you get inventory value per unit. So you value per unit cost first or per unit value first. Later you multiply with the total value of closing stock or total closing stock units. Multiplied value will be the total value of inventory. So whatever rules we are going to learn now mainly targets one unit. Later it will be multiplied with the total units to get the total value. So the valuation rule, which is very famous and everybody remembers this, cost or net realizable value obviously whichever is lower. This is the valuation rules of inventory, cost or NRV, whichever is less. Now, what do we mean by cost? What are included in cost? Now, cost includes three things. First is cost of purchase. Second is cost of conversion. Third is other cost. Now, cost of purchase, basically it relates to raw material. So you buy your raw materials, anything related to those purchase part will come under cost of purchase. Once you purchase raw material, it should be converted into finished goods. So you involve certain cost where raw material gets converted into finished goods. Those are cost of conversion. Other cost, if any cost is incurred during production process, that will come under other cost. Example, say packing. So packing is one type of other cost, whereby if a customer is going to specifically ask for it, you apply them. Since it is again related to production, it becomes other cost. So these are the three aspects what you have. Now, what do we mean by cost of purchase? Okay, now what mainly is involved in cost of purchase? First, all your purchase costs. For this, you will add there is any freight or carriage, obviously inwards, not outwards. Then add duties and taxes, very important, provided there is no refund or there is no credit. So what does this basically means? Duties and taxes are allowed for you to be added, but provided you are not supposed to claim any refund or there is no credit involved. Example, say GST. You pay GST on stock. Now at that time, let's assume that this GST can be claimed as an input. Input tax credit is available for this GST. Then do not consider for addition over here because ITC can be claimed. What is the example for additions then? Customs duty. Customs duty, there is no credit for customs duty paid. It's a taxes paid. So therefore, customs duty will be added over here. So that's how duties and taxes should be considered. No refund, no credit, add. You get credit, there is a refund, do not add. Finally, if there are any direct cost, then add them over here. And if there is any trade discount, it should be deducted. Remember, only trade discount should be deducted and not cash discount. So cash discounts are not allowed to be deducted, only trade discount. Now what are trade discount? Any discount which is arising during purchase or sale of goods. At that time, trade discount comes into the picture. Cash discount comes whenever you want to make the payment. So therefore, only consider trade discount over here. So this is going to be your cost of purchase. Now, once if this is done, the next part will be cost of conversion. Cost of conversion. Now, cost of conversion basically will have three things. One is direct labor, then variable overhead, then fixed overhead. So we will be having a total of three costs. Variable overhead and fixed overhead will come under overheads. Direct labor is another type of element. Now, how do you value cost whenever it comes to direct labor, variable overhead and fixed overhead? Point to be remembered, as I have told you initially, that you initially want per unit cost. Later you will multiply with the total unit. So therefore, when it comes to direct labor, what we do? First we go with direct labor cost, which is total divided by actual production units. So whatever cost is incurred, divide by actual production units, you will get per unit value of direct labor. What about variable overhead? Same way, total variable overhead cost, again divided by actual production. I will write that as AP. Okay, why it is so? Because variable overhead are those overhead which changes according to production unit. Since it changes according to production unit, variable overhead will be the numerator amount, denominator will be actual production. However, when it comes to fixed overhead, it is not so. It's a bit complicated. Now, in fixed overhead, what we say, either it can be actual production or it can be normal capacity also. Now, what do you mean by normal capacity? Normal capacity basically means the capacity after considering all the standby times, all the necessary time given for that machinery. So for that reason, after deducting all the necessary standby times and all, whatever number of units you get, that will be the normal capacity, which means normal capacity are normally on an estimated basis. Okay, so you estimate that according to all the normal time which is supposed to get deducted, so all those time is deducted, finally you calculate how many units can be produced. That is normal capacity. Actual production is the production which you actually do. So therefore, two elements comes into the picture whenever it comes to fixed overhead. So since there are two elements, how do I get the denominator now? Because over here I am talking about denominator. Actual production, normal capacity and all are the denominator. What is numerator? Total fixed overhead cost. So denominator, how to consider it then? For that, there are a total of three situations. One, if actual production is equal to normal capacity. Two, if normal capacity is more than actual production. Three, if actual production is more than normal capacity. Okay, these might be the three situations since there are two types of elements involved in a particular scenario. Now, if actual production is equal to normal capacity, then you can consider either of them, actual production or normal capacity. If normal capacity is more than actual production, then denominator is normal capacity. If actual production is more than normal capacity, then denominator is actual production. Okay, now let's take a simple example on this to just understand what will be the denominator requirement. Now, let's assume that total fixed overhead cost is say 100 rupees. I'll take a small amount so that it becomes easy for us to understand, and say normal capacity is 10. Okay, now if at all I go with the first situation, these two will be fixed. Actual, let's keep on changing. Say normal capacity is 10 only. If actual production is equal to normal capacity, then even actual production is also 10. At that time, denominator can be any of them. So how do you calculate 100 divided by 10? That's how you calculate fixed overhead cost per unit. Then second one, normal capacity is more than actual production. So therefore, normal capacity is 10, actual production, let's hope it as 8, or let's assume it to be 8. Now, in this case, how do I calculate? It is 100 divided by 10. Why? Normal capacity should be the denominator. What about the third one? Actual production or normal capacity is 10. Let's say actual production is 12. If actual production is more than normal capacity, then it is 100 divided by 12. So this is how you have to calculate per unit value of fixed overhead. So to remember this in a simpler way, how do I get it then? Whenever you have this kind of calculation, either it will be actual production or it will be normal capacity, whichever is higher. Consider this for denominator purpose. I hope it is understood. Just look into it. Every time when I took a denominator, whichever is higher is considered. So if normal capacity is more than actual production, denominator is NC, normal capacity. If AP is more than NC, denominator is AP. So because of that, whichever is higher. Now what is the logic? Cost which will be considered for inventory valuation purpose, that should be less. Higher the denominator, lesser the value. So for that reason, consider whichever is higher as your denominator. So this is how you have to consider your fixed overhead mechanism. Labor and variable overhead, anyhow, it depends upon actual production, no problem. But fixed overhead has to be done in this particular basis where you have to consider all these normal capacity actual production mechanism. Now, after this, once our cost of conversion is done, next thing will be other cost. I will not talk much about other cost. Those are the specific cost involved for production purpose other than cost of purchase and cost of conversion. As I've already told you, say packing costs and all will be considered under other cost. Since it is involved in production, it will be added as cost of inventory. Once the cost of inventory is derived, there can be certain other element which comes into the picture. What are they? What happens if there is joint product and byproduct? Now, why are we considering this particular point as a separate element over here? The thing is very simple. Whenever it comes to joint product and byproduct, there will be something called as joint cost. I think this you have already done in your costing subjects. Over there, I think this is one of the chapter you have. So there is joint cost in a particular situation which gets bifurcated into different joint products and also byproducts, which means there is only one cost which gets bifurcated into different products at a particular point. You either call it as split off point or you call it as separation point. Till then, there is a single joint cost involved. So therefore, how do you bifurcate this joint cost between all these products? For that reason, AS came into the picture and told us the rules. Now, how it is supposed to be done then? What they say is, whenever there is joint cost, it has to be divided among what? It has to be divided among joint product on a rational basis. Very simple. It just said if you have a single cost divided into different products, then basically divide them according to a rational basis. A ratio, divide them off. Now, what is the rational basis mechanism I can apply? Normally, what is applied is sales at split off point method. Sales at split off is normally considered as a mechanism for this bifurcation purpose. So that is how you have to consider the joint cost bifurcation to joint product, because joint product is your main product, byproduct is your subproduct. Now what should I do with byproduct then? This is very important. Now standard said either it could be a byproduct or it could be wastage or it could be scrap. You can call it by any name. byproduct, wastage, scrap, etc. Now, all these things should be valued at NRV, very important, and it should be deducted from joint cost. So all these joint products, no, byproducts, wastage, scrap and all should always be valued at NRV, and it should be deducted from joint cost. That joint cost will be bifurcated between joint product. So to summarize this whole thing, what we learned, I can just show it up to you. Say there is joint cost with us. What should we do with this? First, deduct NRV of byproduct. This will be bifurcated between joint products according to what? Sales at split off. So this is how it should be done. So if there is a joint cost, first deduct byproduct NRV, net amount, divide between joint products in a ratio. What is the ratio basis? Sales at split off. So that's how this joint product byproduct mechanism is supposed to be considered. After this, standard talks about cost formulae. Now, what do you mean by this topic? What do we mean by cost formulae? Simple. Whenever you buy any sort of products for a trading purpose, at that time what happens? You will not buy all the products on a single date. You will buy it at different dates according to demand supply. So accordingly, at that particular point of time, the price at which you are going to buy might change in different days. So I am buying it on 1st January, 1st February, 1st March, anything. At that time, every time when you buy, it may not be at the same price. Obviously, it will be at different prices. Now, these things, some of them will be sold, some of them will be in stock. At that time, how do you value those stock according to these different purchase dates? For that, cost formula is important. Okay, so what is the background effect? Different dates you are going to buy. Some of them will be sold, some of them will be in the stock. Stock may, if it is there, how do you consider it? For that, this particular mechanism is important. Now, this cost formulae, what they have done is they have bifurcated into two. One, they said ordinarily not interchangeable, and ordinarily interchangeable. Now, what do you mean by ordinarily not interchangeable and ordinarily interchangeable? Now, I'll first give you interchangeable ka example. Assume that there are a total of 100 Apsara pencils. Pencil business, 100 Apsara pencils are there. Now, a customer came and asked for the pencils. You can give pencil number 1, you can give pencil number 99, you can give pencil number 76, anything. Why? Because all the pencils are similar. Now, I am saying that it is of a similar brand. Say there are different brands also na, in when it comes to pencils, but I am saying similar brands. If that is the case, one pencil is interchangeable with the other. It became ordinarily interchangeable. However, another example, they say there is i10 car which a particular person wants to purchase. That person came to the showroom. i10 car, even though the same specification, same model, everything is the same, but still each car is denoted by an engine number and a chassis number. So at that time, what happened? Even though there are two identical cars, same cars, but still engine number is different. So for that reason, what happened? They are not interchangeable. You cannot say engine number 101 and give an engine number 104 ka car. Has to be given in the same way. That is ordinarily not interchangeable. So ordinarily interchangeable is one product can be replaced with the other. Not interchangeable, it's not possible. So that is the situation in which standard bifurcated them. If it is ordinarily not interchangeable, we apply specific identification method. We apply specific identification method. Okay. Now, what does this method is going to tell us? It tells specifically identify individual value of stock and put it up in your stock sheet. Okay. So basically what the normally it is applicable for automobile industry. So these showrooms, what they normally do, stock sheets what they will have, stock details what they will have, over there they will also have their engine number details as well. So whenever they have engine numbers, whenever a car is sold or a bike is sold or anything, they delete it from their stock records. So whatever stock records are remaining, it should match with that vehicle engine numbers, then it is going to match, otherwise no. So that is how specific identification method is going to come into the picture. If it is ordinarily interchangeable, then you have got two methods. Either you apply FIFO, first in first out, or you apply weighted average method. You know more about these methods, so I am not going to go too detailed into this, but there are two methods which is applicable if it is ordinarily interchangeable, either FIFO or weighted average. But specific identification method, it's not possible. FIFO is not possible. Weighted average is not possible. Suppose if this is the situation, it's not practical to apply all these three methods. At that time and only at that time, the standard allowed certain other methods. So other methods are never given the first preference. Only if you could prove that the primary methods are not possible, then only go with the other methods. In other methods, there are two. One is standard cost method and the other one is retail method. Now, what happens in standard cost method? The management is going to take up some scientific approach and all, and they will decide one standard cost. That standard cost is applicable for every product. So that's how standard cost method works. Retail method, as the word itself says, is normally followed up by the retailers. What they normally do is they won't calculate cost according to cost of purchase plus cost of conversion plus other cost. What they do is they go with the reverse working. What they say is cost is equal to sales minus margin. That's how they do. So again, if you could see both the methods, they are not that good enough for your valuation purpose, but still it is allowed only if the other methods are not practical. Retail method, for example, it's sometimes it might be hard to apply FIFO, weighted average and all, because the number of products might be involved is very high. So at that time they can apply the retail method. So other methods are allowed only if primary methods are not possible to be applied. So that is how your cost formulae is supposed to function, interchangeable, not interchangeable situations. Then finally, after all these things, there are certain exclusions from cost. From cost of your inventory, there are certain exclusions. Now, what are they? First, if there are any abnormal loss, it is always excluded. Normal losses are always excluded. Okay. Now, for example, if one product takes 5 hours to produce, but because of some reason they took 15 hours, abnormal, that extra 10 hours should not form part of cost of inventory. So they are excluded. Second, if there is any storage cost, it is excluded. Storage costs are excluded. Third, if there is any interest cost, even that is also excluded. It could be included only if it is permitted by AS 16. So interest depends upon AS 16 and accordingly it will be allowed. Fourth, selling and distribution overhead is always excluded because it is never related to production. So therefore selling and distribution overheads are excluded. Finally, even admin overhead is excluded if not used for production. So if not used for production, even the admin overhead is also excluded. For example, you pay salary to chartered accountant. Whether that person is involved in production, no, excluded. So that's how all these admin overhead not covered will be excluded from our discussion. So these are exclusions from cost. Do not consider these costs in your cost of inventory calculation. Finally, after all these things, the cost discussion comes to an end. The next part is NRV. Now, for NRV, very simple. It just gives us a formula. Just remember this formula, NRV stuff is over. Now, what is that formula? Estimated selling price in ordinary course of business less estimated cost necessary to make sale less estimated cost of completion. Okay, so estimated selling price in the ordinary course of business, selling price less estimated cost necessary to make sale, which is cost of sales or your selling cost, less estimated cost of completion. If the completion is yet to happen, if the product is yet to finish, estimated cost of completion. So basically, I will consider only these two if finished goods are involved. If finished goods are involved, basically selling price minus selling cost. Cost of completion will come when? It will come when work in progress is involved. So if work in progress comes into the picture, the entire formula is applicable. If finished goods are involved, only first two lines, third line doesn't come because already it is completed. What other cost is there for completion purpose? So for that reason, third one doesn't come for finished goods, but all the three will come whenever work in progress is involved. So this is how you have to calculate NRV. Apply this formula, finally get the value, that is your NRV. So cost or NRV, whichever is less, is the value of inventory of what? Of finished goods and work in progress. So what about the next one then? So the final one what will remain is how do you value raw material? How raw material valuation is supposed to take place. So for that purpose, what should we do? Raw material is normally valued at cost of purchase. As simple as that. Raw material is valued at cost of purchase. You have already seen what is cost of purchase, purchase price, add freight, duties and taxes, blah blah blah. So raw material is normally valued at cost of purchase. However, sometimes raw material might be valued at replacement cost also. Raw materials might be valued at replacement cost as well when both the conditions are satisfied. Now what are those two conditions? First, finished goods are sold below cost. Second, price of raw material is in decline. Now, how do you interpret these two lines? Finished goods are sold below cost. Now, what does that mean? NRV is less than cost. Finished goods, na? So, NRV is less than cost. Okay, are sold below cost. So, NRV is less than cost. Price of raw material is in decline, which means replacement cost is less than cost of purchase. What do you mean by replacement cost? Today, if I have to replace the raw materials, at what price will it be replaced? Which means current value is set in replacement cost. Price of raw material is in decline. If current value is less than the previous value, it is in decline. So replacement cost is less than cost of purchase. So if both these conditions are satisfied, then replacement cost. Any one condition is not satisfied, then it is cost of purchase. Example, assume that cost of finished goods is 100 rupees and NRV is 80. Finished goods are sold below cost, which means this condition is satisfied. Assume that cost of purchase of raw material is 40 and replacement cost is 30. Again, current price is less than the previous price, raw material value is in decline, which means this condition is also satisfied. In that case, what will be the value of raw material then? Replacement cost 30. However, let's say NRV is 800 instead. Instead of 80, NRV is 800. At that time, whether first condition is satisfied? No. Finished goods are sold above cost. So no. At that time, what happened? One condition not satisfied, ho gaya. At that time, what should I consider then? Cost of purchase will be the value of. So that is how you have to consider raw material inventory value. So these are the valuation mechanism of work in progress, finished goods, raw material altogether. As I've already told you, all these aspects are valued separately. They are not supposed to be valued together. So this is AS2 in detail, analysis of AS2 and the charts and summary of this. Accordingly, now let's take up one or two problems. I have taken one problem from RTP and one problem from the old question paper, and we will quickly look into that particular points, and we will see how presentation of an answer and analysis of an answer could be done in those situations. Let's quickly go into that. Yes. Okay, so the first question. A Limited, this is your RTP question. A Limited is engaged in manufacturing of chemical Y for which raw material X is required. The company provides you following information for the year ended 31st March 2020. Raw material X, cost price, freight inward, replacement cost, chemical Y, material consumed, direct labor, variable overheads. Additional information. Total fixed overhead for the year was rupees 4 lakh on normal capacity of 25,000 units. Closing balance of raw material X was 1000 units and chemical Y was 2400 units. You are required to calculate the total value of closing stock of raw material X and chemical Y according to AS2 when net realizable value of chemical Y is rupees 600 per unit. So this is one of the classic questions which might be asked whenever AS2 questions are involved. Now, whenever a question is asked for you, first look into what question is asked, then look into the information. First, what is the question asked? They say calculate total value of closing stock. Of what? Of raw material X and chemical Y, which means there are two elements in inventory then. One is chemical Y, which is your finished goods, and then there is raw material X. So there is a finished goods and raw material. What is the valuation mechanism then? Finished goods, cost or NRV, whichever is less. Raw material, not cost or NRV. It is valued at cost. If at all two conditions are satisfied, it will be valued at replacement cost. Accordingly, now you have to calculate. Now, first thing what we normally calculate is we first go with finished goods valuation, then we will go with raw material, because in raw material, one of the condition is finished goods are sold below cost. So for that reason, first let's go with the finished goods requirement. So over there, if you now look into it, finished goods cost, how do you calculate? Cost of purchase, cost of conversion, other cost. So if you could see here, raw material excess, cost of purchase, there is labor and overhead, that is your cost of conversion. Even fixed overhead is there, that is your cost of conversion. There is no other cost in the question, only cost of purchase and cost of conversion will be done. How do you calculate cost of purchase? Cost of purchase is calculated as purchase price, add freight or carriage, duties and taxes, etc. Now look into this, cost price and freight inward. These two will be added. Don't consider replacement cost because that is given only for valuation purpose. So now if you could add these two, you will get 440. Now correlate this. So 440 is material consumed as said in the question. Okay, so that is how bifurcation has taken place. So once you do that, there is material consumed, cost of purchase, cost of conversion, labor and variable overhead. Good for us. They directly gave you the cost per unit. Great. What about the next one? Fixed overhead. They did not give you per unit. They gave you in total. So what should I consider? Value is 4 lakh. Only normal capacity is given of 25,000 units. Now, if that is the case, assumption is normal capacity is equal to actual production. Denominator could be any of the two. So at that time, it will be what? 4 lakh divided by 25,000. Get per unit. Add this up. Your total cost per unit of finished goods. Once that is done, compare it with NRV. NRV is given in the question as 600 per unit. Finished goods valuation is over. Once that is done, apply for raw material. So for raw material, what information is given? 320 is the replacement cost. That you have to compare and then you can make out. But one condition is already satisfied. What is that? Price of raw material is in decline. Because cost of purchase is 440, replacement cost is 320, price of raw material is in decline, then current price is less. So one condition is already satisfied. Another condition is finished goods are sold below cost. That depends upon NRV and cost. That you will come to know over the calculation. So I have already done that calculation part. Now if you could look into it, raw material X 440, we got 440. Then total cost per unit of chemical Y, raw material X, labor, variable, fixed overhead. Fixed overhead, as I have already told you, 45,000 divided by 25, sorry, 4 lakh divided by 25,000. You'll get 16 rupees. So total cost is 656. Once that is done, then apply your formula. So first valuation method will come. So for valuation, write certain sentences. So what does it tell? For finished goods, cost or NRV, whichever is less. For raw material at cost, but if finished goods are sold below cost, price of raw material is in decline, consider replacement cost. That has been written in the paragraph. Accordingly, now if you could apply, what happens? First calculate per unit. 656 or 600, whichever is less. We got 600. Multiply that with number of units of chemical Y. Number of units of chemical Y is 2400 units. Multiply, you'll get total value of chemical Y, finished goods. Now if you could look into it, 656 is cost, 600 is NRV. NRV is less. Finished goods are sold below cost, which means even first condition is also satisfied. So therefore, raw material will be valued at replacement cost. Okay, reason being two conditions are satisfied. Multiply that with the number of units, 1000 units, you'll get total. Okay, so once that is done, take up the total, that will become your total value of inventory. So this is how you have to approach the question and get your suitable answers out of it. I will take up one more question now. Now in this particular question was asked in previous exams, so I have taken that question itself. I'll quickly read that up. Mr. Rakshit gives the following information relating to items forming part of inventory. As on 31st March 19, his factory produces product X using raw material A. 800 units of raw material A purchased at 140 per unit. Replacement cost of raw material A is 190 per unit. 650 units of partly finished goods in the process of producing X and cost incurred till date is 310 per unit. These units can be finished next year by incurring additional cost of 50 per unit. 1800 units of finished product X and total cost incurred is 360 per unit. Expected selling price 350 per unit. In the context of AS2, determine how each item of inventory will be valued as on 31st March 2019. Also, calculate the value of total inventory as on 31st March 2019. This is the question which is asked for us. Now, if you could look into it, three separate points and they want individual valuation, total it up, total value of inventory. First thing, our raw material is A and product finished goods is product X. Now accordingly, if you now look into the first point, 800 units of raw material A purchased at 140 per unit. Purchased at 140 per unit means what? It means the purchase price, cost of purchase is 140 and the replacement cost is 190. Now for raw material valuation, two condition, any one condition not satisfied, we have already seen that. If you could look into it, I need not even check what is finished goods cost. Just by looking into raw material itself, my job is done. Why? Because cost of purchase is 140, replacement cost is 190, which basically means price of raw material is not in decline. The value is more now. So because of that, what should I do? Consider directly 140 as the value of your cost of raw materials because one condition is anyhow not satisfied. Later, going to the second point, it talks about partly finished goods, which means what? Work in progress. Now for that they said cost is 310. First, what is the valuation norm is applicable for work in progress? Cost or NRV, whichever is less. So 310 is the value of our cost. Now we need NRV. For NRV, what they gave you? They said incurring additional cost of 50 per unit. How do you interpret this? For NRV formula, estimated selling price less estimated selling cost less estimated cost of completion. 50 becomes estimated cost of completion. Okay. Now selling price is 350 per unit. So accordingly, 350 is selling price less. Selling cost is not given in the question, so 0 less. Cost of completion is 50, NRV is 300. Cost or NRV, whichever is less. So 310 or 300, whichever is less. So the value became 300. Okay, I hope it is understood. Finally, 1800 finished product is considered. For that, whether cost of completion should be considered? No, because it is already completed. So what should I do then? Directly consider 360. Selling cost is not there. 360 or 350, whichever is less, consider this at 350. Multiply with the number of units to get the value of inventory. So that itself has been written over here, the answer. The first paragraph is going to tell us about the valuation mode and valuation norms that has been considered, and after that, based on the principles, keep on writing your answer. The first value is at 140, multiplied with the number of units. 800 into 140 will give me the value. Second, NRV has to be calculated as said. 300 is NRV, then compare 310 or 300, whichever is less, multiply with the number of units. Finally, finished product 360 or 350, whichever is less, finally get the value. One thing I haven't done, which you people have to do, what is that? Add all the 3 points to get the total value of inventory. So this is how a question, if it is asked in the exam AS2, normally it might be asked in the exams, you have to approach it this way, whereby analyze what is asked over there, then see the valuation formula, apply it, rule, done. That's how you are going to get your value. So now, before we wrap up this particular standard, again as said, I will give you the highlight points. What are the highlight points I have to consider for remembering purpose? First highlight point to be considered is, what are the exclusions from AS2? Okay, second one, what is the definition of inventory? Third point, what is the valuation principle when it comes to finished goods and work in progress? For that, there are certain sub points. What are those? One, what do you mean by cost? Second, what do you mean by cost of purchase? Third, what do you mean by cost of conversion? Fourth, what do you mean by other cost? Fifth, what should I do whenever there is joint and byproduct involved? Next, what is the cost formulae I have to adopt? Next, what are the exclusions from cost? Last, what do you mean by NRV? So these are there for your valuation of finished goods and work in progress. So one by one, if you could look into it, these are interconnected. For example, these are interconnected. So one, if you know, automatically you will know the other points. So interconnected points you have to consider. After that, it will be continued with the other points as well that you have to take up. Last but not the least, what is the valuation principle whenever raw material is involved? So these are the highlight points what we have whenever we deal with AS2. So once you remember these highlight points, automatically will remember what is it, what is inside it. Then you can easily correlate, especially on the previous day of the exam. That is my mindset. That if on the previous day of the exam, if you could look into these highlight points, automatically dimag ki batti jalao, you should remember what is there inside them. Later you can directly go to the exam and you can bring up all these points whenever a problem is asked. With AS4, contingencies and events occurring after balance sheet date. So the title of AS4, which we have to bring it whenever you deal with the standard answers. So in the accounting standard answers, if you are bringing up, bring the title as well. So the title is contingencies and events occurring after the balance sheet date. So basically what they are trying to tell us in this standard, there might be certain contingencies, there might be certain events which occurs after the balance sheet date. How are we supposed to consider that on the balance sheet date? Should we consider it, should we not consider it, etc. are the point of coverage in AS4. Now, starting with, what do you mean by the term contingencies? So let's try to see one by one as to what does it mean altogether. Now, what do we mean by the term contingencies? So contingencies are basically condition or situation and outcome of this condition or situation depends upon occurrence or non-occurrence of future uncertain events. Okay, so basically contingencies are conditions, situations which outcome basically is profit or loss, depends upon occurrence or non-occurrence of future uncertain events. So therefore it will be called as contingency. Okay, so this is one part of the standard. The next part, what do we mean by events occurring after the balance sheet date? Important one. This is the coverage of AS4. So basically, if any event which is occurring after the balance sheet date, only those are covered by AS4. So therefore, first you have to see, for the coverage purpose, is it an event occurring after the balance sheet date? Now what are they? These are significant events. And this can be both favorable and unfavorable. And these events occurs between balance sheet date and financial statements approved, or date of financial statements approved by appropriate authority. Okay, so basically what are events occurring after the balance sheet date? They are events which are significant. It could be favorable, unfavorable. So it may lead to a profit making event or it might be a loss making event. Anything is fine. And that event is occurring between balance sheet date and date of approval of financial statements by the appropriate authority. Only they are covered by AS4 provisions. So if I have to take up an example now, example, if financial year is 2018-19, then balance sheet date is 31/3/2019. So anything after balance sheet date, which is 1st April 2019 to, let's assume that this is a company, date of financial statement approved by appropriate authority. Who are appropriate authority for the company? Directors. So the day on which the management, the directors are going to approve their financial statement, that is the date covered here. Example, let's assume that that approval is done by 31/8/2019, which means any event occurring between 1st April 2019 to 31/8/2019 will be covered by AS4. Anything coming before 1/4/2019, no, it's not covered by AS4. After 31/8/2019, again, no. Anything in between, that is the only thing which is considered. So that's how you have to know what do we mean by event occurring after the balance sheet date, and try to bring these sentences whatever I have written. Significant events, both favorable and unfavorable, occurring between balance sheet date and date of approval of financial statements by appropriate authority. Okay, now once it is contingencies and events occurring after the balance sheet date, what it may lead to. So those events what is considered under AS4, they will be divided into two. Either it will be an adjusting event or it will be a non-adjusting event. First, what do we mean by adjusting event? What is covered under adjusting event? It is those events which provide further evidence for conditions already existing on balance sheet date. So, adjusting events are those events which provide further evidence for conditions already existing on the balance sheet date. So, it basically means that there is something which has happened on the balance sheet date itself, and whatever is happening after the balance sheet date is only giving you further evidence. So it's only giving you whatever was already thought of, it's just giving you the final outcome. So that is called as an adjusting event. Okay, for example, if I have to take up an example now, say a fire has occurred, okay, a fire has occurred in debtor's premises, and this happened on say 25th of March 2019. Okay, you came to know about the news and you know that this particular fire which has taken place, there is no insurance for this, which means our debtor has suffered heavy losses which may lead to he not paying us the debt. We know this particular situation. Assume that on 5th of April 2019, your debtor declared himself as insolvent. So what is happening? 25th March, we already knew that this person is in great financial trouble. He doesn't have insurance, which means he may not pay us the debt. 5th April only gave you the confirmation of what you had already thought on 25th of March. So what happened? Whatever 5th April happened, that is only giving you further evidence for condition already existing on the balance sheet date. What is that condition? Occurrence of fire. So therefore, this situation will be considered as adjusting event. Okay, so there has to be a major event which has taken place before balance sheet date itself. By balance sheet date, you know that. After balance sheet date, it's only giving you confirmation of what you had already thought within the balance sheet time. So that is how adjusting event comes into the picture. Now, what do you mean by non-adjusting event? Basically, non-adjusting events are new events. Okay, non-adjusting events are new events. As on the balance sheet date, there was no condition altogether. Example, you make new purchases, you make sales, you pay salary. All these things basically are entirely new. There is nothing connected to the balance sheet date for this, because you do your day-to-day job. There are a lot of events which happens on new basis. So all these things will be non-adjusting. So if you make your purchases on 5th of April, you never pass an entry as on 31st of March. You pass it on 5th April only. Reason being, basically on 5th April you made a new purchases. That's it. So therefore, it will be an entirely new event. If it's a new event, it's a non-adjusting event. Now a question comes, if this is the case, in the example what I have given you, if at all I have to convert that adjusting event into a non-adjusting event, then how can I do it? Just see here, that fire occurred, the same example which I gave you, if that fire occurred in debtor's premises on 5th of April, okay, fire date I will make it as 5th of April, and 15th of April insolvency date I will do. So 5th of April fire occurred, 15th of April insolvency took place. If that is the case, then just think about it. At that time, as on 31st of March, balance sheet date, was there any condition? No, he was fit and fine. There was no problem with this business, no issues whatsoever. 5th April, fire occurred. Insolvency ka problem occurred on 5th April, which means it occurred in the next year. It's a new event. So same example, we can just convert it into an adjusting event or a non-adjusting event. If that condition existed on the balance sheet date, it is adjusting, otherwise it is non-adjusting. Now, if at all it's an adjusting event, how or what should be done? Adjustments are done as on the balance sheet date. So adjustment towards assets and liabilities are done as on the balance sheet date. So even though it has occurred after the balance sheet date, since condition already existed, adjustments are done as on the balance sheet date. If at all it is non-adjusting event, no adjustments are done. If at all it's a non-adjusting event, don't do any sort of adjustment. So this is how you have to deal with adjusting event and non-adjusting event. Okay, slight extension to this standard now. So first what I am going to do, again I will be writing only the interpretation part now. Events, adjusting and non-adjusting. If it's adjusting, what should I do? Make the adjustments on the balance sheet date. If at all it is non-adjusting event, what should I do? There is no need for any adjustments. However, slight extension, let's try to do it. What it is? Suppose if this non-adjusting event is significant, assume that you are making a very large purchases or a high level machinery has been purchased or anything like that. If at all it's a significant one, see, collecting money from debtor, making purchases, making sales, now these things are not significant. This happens on a day-to-day basis. If it's material is what I meant, that the shareholder should know about this. If at all a non-adjusting event, whatever has happened, is significant in nature, then it should be disclosed in director's report or disclosed in appropriate authority report, because the users should know that something has happened. So for that reason, they have to put it in their report. So this is no adjustment needed when it comes to non-adjusting, but if it is significant, you should give a note in appropriate authority books or appropriate authority report, not in financial statement. In appropriate authority report, you are supposed to do it. Okay. Then there is one more thing which we have to know here. What is that one more thing? There is an exception to the rule. Now, what is the exception ideology? The point is, non-adjusting event, no adjustment to financial statement should be given. However, if it comes in the exception, it becomes an adjusting event. Make adjustment to balance sheet date. Now, what is that exception to the rule? The exception to the rule is if going concern assumption is not followed or going concern assumption cannot be established. Okay, even though it's a non-adjusting event, an event occurred in the next year, but it is affecting the going concern assumption, it is affecting the life of the business, at that time you make it as an adjusting event. Example, fire occurred in factory premises of a company and it's a huge fire which has made going concern assumption go wrong. This happened on 1st of May, which is in the next year. Appropriate authority approval is yet to happen. 1st of May this took place. At that time, even though it is taking place after the year, but still it is an adjusting event because going concern assumption is going wrong. So as on 31st of March, you should bring this in the financial statement. How do you bring it? We know from AS1 that if going concern assumption is not established, you have to prepare financial statement according to liquidation basis or realization basis. So instead of cost basis balance sheet, now you have to convert it into realization level balance sheet. So that is how, if going concern assumption is not followed, you have to make it as an adjusting event. Okay, so this is supposed to be the way in which we have to see AS4. There was one other doubt which normally we used to have as to how do we deal with proposed dividend. So for proposed dividend, what has happened is the statute got changed. Since the statute got changed, which is from 1956 Companies Act, it changed into 2013 Companies Act, where in that law it told us that dividend should be accounted in the year of declaration, not in the year of profits. Since it is supposed to be considered in the year of declaration, dividend will be shown as a note to the current year financial statements. So for 2018-19 financial statement, declaration will happen in 1920. So entry will be done. I will write it and show you. If 2018-19 financial statement is there with us, balance sheet date will be 31/3/19 and declaration date obviously will be somewhere around 30th September 19. Example. So 19 to 18-19 dividend is declared in the year 1920 and according to statute it should be accounted in the year of declaration. Since it is statute, accounting standard does not go beyond that. So therefore 18-19 you need not account for the dividend, instead it is just shown as a note for financial statement users so that they know what is going to happen. Okay, so this is one change. Initially, when old AS4 was there, proposed dividend used to be written in the year of profit itself, but now it is written in the year of declaration according to new statute. So that is how you have to deal with AS4. So AS4 is a very simple small standard, but the important aspect is how do you decide whether it is adjusting event or a non-adjusting event. Now I can give you one trick to actually understand how adjusting non-adjusting works. See, by the balance sheet date, if you find any conclusive element, consider that as adjusting event. It has to be conclusive element. Example, negotiation is taking place as on the balance sheet date, but actual agreement took place after the balance sheet date. Now, whether negotiation is conclusive evidence that you are going to make a purchase or sale? No. So therefore, it is not an adjusting event. However, agreement is entered on balance sheet date, but executed after the balance sheet date. Agreement is entered, but the actual purchase sale is executed after the balance sheet date. Here, do we have a conclusiveness? Yes, because there is already an agreement. You can't go beyond the agreement. Then it becomes breach of contract and all. So if there is an agreement, then basically everybody will abide by it. So therefore, what happened? This became an adjusting event. So for adjusting event to happen, you should find certain conclusive evidence. You should find that this is already there. After balance sheet date is only giving you confirmation. If yes, AS4 adjusting event. If no, it is non-adjusting event. So that's how you have to deal with it. So first, event occurring after the balance sheet date, date of approval in between. After that, adjusting, non-adjusting, adjusting, further evidence, non-adjusting, new event. Adjusting, make the adjustment as on the balance sheet date. Non-adjusting, don't make any adjustment. If significant, director's report. If at all going concern assumption goes wrong, adjusting event. That's how AS4 will be taken up. So this will be the theory aspect. So make sure that your judgment point is strong when it comes to this standard. So now let's take up one or two questions which I have picked it from your RTP and MTP, and accordingly let's see how the answers could be brought up. So let's quickly go towards the questions. Yeah. So I will read up the question now. A fire on 2nd April 2020 completely destroyed a manufacturing plant of Omega Limited, whose financial year ended on 31st March 2020. The financial statements were approved by appropriate authority on 15th June 2020. It was expected that the loss of rupees 10 million would be fully covered by the insurance company. How will you disclose it in the financial statements of Omega Limited for the year ended 31st March 2020? So balance sheet date is 31st March 2020. Approval date is 15th June 2020. So and event is occurring on 2nd April. So balance sheet date 31/3. approval date is 15th June, which means it's an event occurring after the balance sheet date. It is in the coverage of AS4. It is happening in between. Now the point is the event took place on 2nd April. What is that event? Destruction by fire. So manufacturing unit got destroyed by fire. Now, will there be any condition as on the balance sheet date? No, it's a totally new event because fire you can't predict before. So it's a new event. So therefore, since it is a new event, it is a non-adjusting event. First, you have to conclude that it's a non-adjusting event. And afterwards, if it's non-adjusting event, three situations. One, going concern assumption going wrong, it will become an adjusting event. Two, if it's significant, then director report. Three, no going concern assumption, non-significant, sit quiet, don't do anything about it. Okay, now what will you bring it over here? The point is, first, it is fully covered by the insurance company. Suppose if insurance was not there, then there were chances that going concern assumption might go wrong. So a total chance is there because the amount involved is huge. But the company expects, or the company is almost sure, that insurance cover will totally take it up. So therefore, what happened? Going concern assumption may not go wrong here. Okay, you can bring it in the answer saying that we will assume going concern assumption will not go wrong because there is already an insurance coverage. However, since it is destruction and user should know about it, this should be presented as a director report element. So this should come as a note in the director's report. That has to be our answer. Okay, so analyze like this. So first, it is occurring after balance sheet date but before financial statement approval, so therefore it became AS4 coverage. After that, since it's occurring a new event, it's a non-adjusting, and since insurance coverage is already there, going concern assumption will not go wrong. Finally, since it is significant, a note is needed in the director's report, or a disclosure is needed in the director's report. So accordingly, if you now read institute answer, let's see whether we can correlate it or not. The event is a non-adjusting event, we decided. Then, however, it is necessary to consider the validity of going concern assumption having regard to the extent of insurance cover. Since it is said that loss would be fully recovered by the insurance company, fact should be disclosed as a note to financial statements. So basically it should be given as a note. That is what we had discussed and that is what we got it over here. Next, let's go to another type of question. This is in MTP. This question is there in the recent MTP given by the institute. The financial statements of Alpha Limited for the year 1920 were approved by the Board of Directors on 15th July 2020. The following information was provided. 1. A suit against the company's advertisement was filed by a party on 20th April 2020 claiming damages of 25 lakh. Let's assume it, let's discuss it one by one. But before that, approval date is 15th July. So 15th July 2020 is the approval date. So coverage of AS4 stops as on 15th of July. Okay. Now, first see, the date is 20th April. So it is within the time. What are they saying? A suit against the company's advertisement was filed by a party claiming damages of 25 lakh. A suit has been filed, which doesn't mean that we are going to lose the suit for sure. We may win it, we may lose it. What happened? This arose, or this gave a need to explain, or a need to go with contingencies. So the point is we may lose the case, which means occurrence or non-occurrence of future uncertain events. So therefore it's a contingency for us. Then does this relate anything as on the balance sheet date? No. If you could see here, the filing took place on 20th April itself. So therefore it's a new event and it's a contingency. It's not an event totally applying the financial statement. It's a contingency. And do we need a note to the financial statement because contingency is shown as a note? No, not needed, because it is happening after the balance sheet date. It's a non-adjusting event, or it's a non-adjusting element. So therefore do not consider. Okay, second one. The terms and conditions for acquisition of business of another company had been decided by March 2020. So what is happening? Terms and conditions of acquisition of business had been decided by March 2020. Financial resources were arranged in April 2020 and amount invested was 50 lakh. So you wanted to invest in another company. Terms and conditions were already decided by March 2020. Only financial resources were passed on in the month of April. Now see, terms and condition. Will this give us a conclusive evidence? The answer is yes, because terms and conditions comes in the agreement. There is already an agreement. Only amount arrangement and investment is done in April. So what happened? This became an adjusting. So that is how you have to decide, because whatever resources you are giving is only further evidence of condition already existing on the balance sheet date. So therefore, consider it as an adjusting event. Okay, next. Theft of cash of 5 lakh by the cashier on 31st March 2020 was detected on 16th July 2020. Okay, March already a theft has taken place, but it came to be known on 16th of July. Now the point is, if it was a normal question for us, it is an adjusting event. Why? Because theft already took place in the month of March. You detected in the month of July. But the point is, what is the detection date? The detection date is 16th July. Approval date is what? 15th July. It's already approved on 15th July. You detected it on 16th July. What happened? It is not even covered by AS4. It's non-adjusting and it's not even covered by AS4 because it doesn't come within the time limit. So therefore, do not cover this in AS4. Next, the company started a negotiation with a party to sell an immovable property of 40 lakh in March. The book value of the property is 30 lakh on 31st March. However, deed was registered on 15th April 2020. So what's happening? Negotiation is happening in the month of March. Then execution of deed happened in the month of April next year. Now the important thing is they have used the word negotiation. They did not use the word agreement. Whether negotiation is a conclusive evidence that the contract will be entered into, or whether the negotiation will give you the final evidence that the agreement or the entire transaction is going to happen, the answer is no. Negotiation may work well, may not work well. So you come and sit in front of me, we negotiate. Either you agree, either you don't agree. Anything is possible in negotiation. But if it is an agreement, you have already decided, which means you can't go back. So therefore, since only negotiation was there in the month of March, what happened in the month of April is an entirely new event. So therefore, it is non-adjustment or non-adjusting event. So negotiation will not lead to a conclusive evidence. Negotiation might go wrong, negotiation might be positive or negative. So therefore, do not consider. Next, a major fire had damaged the assets in a factory on 5th April. However, the assets were fully insured. 5th April is a new event, fully insured. So therefore, going concern assumption will not go wrong. So it's a non-adjusting event for sure. And you just have to give a disclosure in the directors. So that's how you have to answer this up. Now if you could see there, answer number 1, it's a non-adjusting event. Suit against the company is a contingent liability. We have seen that. I'm going to share these notes to you. Just make sure that you see the description column. Over there is a PDF link given to you. Open that link and download it. This material will be available to you. Okay, so I will just give the overall answer. You can read that answer specifically later. Then second one is adjusting event, as I have already told you, because terms and condition is the conclusive evidence for us. Third one, non-adjusting event, because it is detected on 16th of July. It does not even cover in AS4. Then fourth one is non-adjusting event because only negotiation has taken place. You don't have any other conclusiveness which has happened. Fifth one, it's a new event because it is occurring after the balance sheet date. No going concern assumption is destroyed, or no going concern assumption is going wrong. So therefore, you just have to give a report under appropriate authority. Okay, so this is how you have to deal with AS4. I hope everybody understood and this standard is clear. The next one is going to be AS5, which talks about net profit or loss for the period, prior period items, and changes in accounting policy. Okay, so this is the title of the standard. You can see that the title is a bit vast, but yes, you have to bring these titles when you deal with the exam point of view. So it deals with net profit or loss for the period, prior period items, and changes in accounting policies. Now, basically, what is this standard on an overall basis is going to tell us? It is going to tell us how classification and disclosure of certain elements should happen when you go for net profit or loss for the period. So it mainly talks about classification and disclosure at the time of ascertaining the profit or loss. Okay, so when P&L statement is done and all those times, what kind of disclosure is needed, what kind of classification is needed, so on and so forth are the important nature of AS5. Okay, now first thing what the standard tells us is that if all income or expense belonging to a particular period should be considered for profit or loss of that period. So accrual and all comes as a major impact over here. So basically salary belongs to March, but it is paid in the month of April. Since the expense belongs to March, it should come in P&L of March, or it should come in P&L of that year only. So that's how they said income or expense, wherever it belongs, it should come in that period of net profit or loss. Okay, now from the classification point of view, the entire net profit or loss what you derive in the P&L statement and all, that will be bifurcated as number one, ordinary activities or ordinary items. So basically the first element of net profit or loss classification. So entire AS5 is done through this classification only. So first classification is ordinary items. Now what are they? These items occur in normal course of business. Okay, so basically it is done from the business point of view. So for in furtherance of business or anything of that sort, it will occur in the normal course of business. So your purchases, sales, so these are your example: purchases, sales, salary, rent, etc. All these things are basically your ordinary activities or ordinary items, because this is going to happen on a general basis. So it occurs in the normal course of business. There is no difference as such. However, in this ordinary item itself, if there is any amount, nature, or incidence, if they are significant, then they are called as exceptional items. They are called as exceptional items, and these exceptional items should be separately disclosed. Okay, so ordinary items, it occurs in the normal course, but either the amount or the nature or the incidence is in such manner that it is significant, it is material. Then you call them as exceptional item. These exceptional items should be separately disclosed. Okay, if I have to give you an example now, assume that salary is an ordinary item, But arrears of salary, if I have to give that example, arrears of salary. So backdated change in salary is made and that salary is paid now. So nature and amount are different. It is not normal. It's kind of different now. So therefore it became an exceptional. In the sense it is normal but material, significant. So therefore it became an exceptional item. Now the point which you need to understand is Schedule 5 or Schedule 3, not Schedule 5. Schedule 3 of Companies Act talks about financial statement. Now over there when they talk about it, they say that there is no need for a separate exceptional item. Okay, so a separate exceptional item and all are not needed. Here it is done only with the mindset that there is a term called as exceptional item, just to explain that it is given in the material as well. So in the exam when you write it, just write a note at the end saying that exceptional item disclosure now is not valid. It's not shown. Okay, but in the material it is there. So just to tell you and classify something as exceptional item, it is considered over here. Okay, so that is number one, which is ordinary item. In that another subdivision called as exceptional item. Now the second one, we call them as extraordinary items. Extraordinary items. Now what do we mean by extraordinary items? Basically opposite to ordinary, it do not occur in normal course. Okay, it do not occur in normal course of business. It's a new one. So by nature, it's a new thing. You can't expect that to happen. So those things are called as extraordinary items. Now, whenever there are extraordinary items, one, for P&L, it has to be included. It should be shown as a separate line item in P&L. That is number one. Second, it should be separately disclosed. What are separately disclosed? Nature and amount. So what is the type of extraordinary item took place and how it impacted the profits, how it is going to impact our overall business. So those things are supposed to be disclosed at the end. So extraordinary is one which is shown separately, that is number one. At the same time it should be separately disclosed. Okay, now if I have to give you certain examples, then if at all, I think I've already told you this when first group was discussed, that AS12, if there is refund of government grant, it's an extraordinary item. Suppose if at all any authority comes and seals your premises, that's an extraordinary item. Suppose natural calamity takes place, that's an extraordinary item. So these things are extraordinary items for you. But I just want to add up over here, extraordinary item always depends upon business to business. So you have to analyze separately. Not all the time everything will apply to every business. So therefore, it's always dependent upon business to business. You have to look into it and then decide. If I have to give you an example, for a normal trading concern, natural calamity is an extraordinary item. But for insurance company, this natural calamity is an ordinary item because insurance claim is common for them. For me, collecting the insurance claim, it's extraordinary because it doesn't happen in the normal course. But for the insurance company to pay insurance claim, it's ordinary. It's their business only. So since it is their principal business, it's their ordinary item. So it always depends upon business to business. That's how you have to take care of it. So example wise, natural calamity, which is earthquake, volcanoes, anything. Then refund of government grant, etc. So all these things will be considered as extraordinary item for us. After this, the third one, third classification, prior period items. Okay, prior period items. Now, what is the technical definition of this particular element? Income or expense arising in current year as a result of errors or omissions in preparation of financial statements in one or more prior periods. Okay, I deliberately have brought these sentences even though it seems more. In simple terms, if I have to tell you what do we mean by prior period item, it's basically mistakes. That's it. But when you bring it in the exam, you have to bring the technical words over there. So it is income or expense arising or which is shown in the current year, which is arising in the current year as a result of errors or omissions in the preparation of financial statements of one or more prior periods. Example, in the prior periods, in the previous times, if you have made any mistake, which is now evident and you can clearly see that for the current year, it's a prior period item because you made an error in the previous time, now you are rectifying it. Example, actual stock value is 4 lakh, but by mistake you wrote only 3 lakh. Now you came to know that 1 lakh stock we missed. Now you want to bring it up. It's prior period item because it should have been included in the previous uh, financial statement itself, but now it is getting included. So therefore it becomes a prior period item. So that's how a prior period item comes into effect. Okay, so basically it is just an error occurring in the last year. You are knowing it now. That we call it as prior period item. Now, whenever you have prior period item, separate disclosure is compulsory. You have to disclose it. What are the type of prior period item you have considered? So what is the nature of that prior period item? What is the amount which is going to affect the P&L? So that has to be a separate disclosure when you deal with prior period item. So basically extraordinary item does not happen normally. Prior period item, there was a mistake. So that is the difference between these two. Then fourth one, changes in accounting estimates. Okay, now basically a lot of things in accounting is done according to estimation basis because there is a lot of needs. Say prudence is there, normal day-to-day business activities are there. Now in all those situations, what happens? You have to deal with certain elements on an estimation basis. So whenever there is an estimation basis, because of change in circumstances, or better methods, so all these nature, there are different other requirements. Because of this, change in estimate might take place. Okay, so circumstances might got changed. For example, we thought that debtor may not give us 10% of the debt, but automatically now we came to know that this guy has incurred huge losses. So now that 10% is now should be 70% because circumstances got changed. So initially there was one circumstance, now it is a different circumstance. So therefore, you have to make sure that this estimate also keeps on getting updated and changed. Okay, now one of the best example for this is useful life and residual value. Just remember AS10 for this. So what does AS10 tell us? Every year you should review useful life and residual value. If there is a change, then make it, and this change is estimate. I initially estimated that I can use the asset for 5 years. Now I can use it only for 2 years. What happened? Estimate got changed. Circumstances got changed. So therefore, if there is a change in estimate, then you have to make those changes. Now, by default, by nature, it can never be prior period item. Last year debt was not recoverable only to the extent of 10%, so you provided 10% estimate. This year 40% is not recoverable, so you are changing from 10 to 40. Now will you call this as last year only you should have given 40, it's a prior period item or a mistake? No. Last year circumstance told me 10%, this year is telling me 40%. So by default, don't assume that it's a prior period item. Changes in accounting estimate will be different itself. Okay. Now, one of the very important point of this particular standard is changes are recorded in the place where original element is recorded. Now, just try to understand. Provision for bad debt is what type of item? Provision for bad debt is a normal, is an ordinary item because it occurs in the day-to-day life. If provision for bad debt is changing, ordinary item is changing, then change in estimate is given to ordinary item. Okay. Now, government grant is getting refunded. It's an extraordinary item. Say you estimated the refund amount to be 5 lakh, but actual refund came up to 6 lakh. If you are making this estimate changes, where will you make it? Extraordinary item. So the place in which the original item comes into the effect, changes in estimate will be applied in that place itself. The furniture got destroyed by fire. It's an extraordinary item. So therefore, scrap value is estimated. Scrap value keeps on changing. You make changes to extraordinary item itself. So where the original amount is shown, where the original element is shown, changes in estimate is given over there only. Okay. Then how to deal with the disclosure aspect of this particular standard? So disclosure wise, it is given if it is significant. Again, materiality effect comes into the picture. If whenever you make a changes to the estimate, if it is significant, then you have to disclose it. 10-year useful life became 2 years. The huge change. You have to disclose it. Okay. Now, whenever disclosure comes into effect, number one, if it affects only current year, then disclosure only for current year. If it affects current and future, then disclosure will apply for current year and future years. This is number one. This is number one disclosure needed. Now, for example, bad debts. So 5,000 bad debts has turned 50,000. It's an only change in estimate applicable to the current year. Disclose it in the current year. Useful life getting changed. If useful life gets changed, depreciation gets changed. Depreciation is an yearly segment. Therefore, it applies for current as well as future years. Then the next disclosure element, if at all, amount wise. So if amount is derived, then disclosure requires amount. If amount cannot be derived, disclosure wise provide the fact. Okay, disclosure wise provide the fact. So this is how disclosure element of accounting estimate are supposed to be done. So first, there are estimates which keeps on changing depending upon the circumstances, methodologies, business, etc., etc. Whenever changes are made, it should be made in the original place, and it's a common thing which is going to happen. Later, whenever there is a change, if it is significant, disclose it, and the disclosure requirement comes into the effect. So this is about accounting estimate requirement, the fourth classification when it comes to AS5. The final classification, fifth one, talks about changes in accounting policies. Changes in accounting policies. Now, what do you mean by accounting policies? Basically, they are principle and method to apply such principle. This was covered in AS1. So accordingly, whenever there is change in accounting policies, first thing to be understood, only if it is allowed by statute or allowed by AS, or it leads to better presentation. So it is allowed to be changed only if one of these conditions are satisfied. Otherwise, first of all, it's never allowed. Okay, so it should come under statute or AS or better presentation. Once a change comes into the effect, when it comes to change in accounting policy, once the change comes into the effect, at that time disclosure is compulsory. Now, what type of disclosure should come? Number 1, current year. Number 2, future years. Same as accounting estimate only. Current year, amount derived, amount not derived. If the amount is derived, then consider it as amount disclosure. If amount is not derived, consider it as fact. Fact is supposed to be disclosed. For the future years, the effect should be disclosed in current year. How it will affect future years will be disclosed in the current year. So this is how accounting policy effect comes into the picture. So allowed only if these conditions are satisfied. Later, the disclosure requirements when it comes to this. But there is one important thing which you have to understand. Normally it is targeted in the exam. What it is? Not change in policy. There are certain elements which you have to understand. Not change in policy. Even though you find that there is a change, this is not considered as a change in accounting policy. What are they? Number 1, transaction effect, material changes. Okay, now transaction was considered in a way which is now entirely different. Okay, again I repeat, when it comes to a transaction mindset, that there was one transaction which was considered in one way. Now you are totally changing that to other way. Example, for gratuity purpose, this is the example given by the institute also. Gratuity or a simple lump sum payment used to be done before. Now you want to make it as a formal policy or formal plan. Simply a lump sum payment of say 10,000, 1 lakh, 10 lakh, something was given for your employees as gratuity when they are retiring. But now you make a policy saying that how many years they have worked, how the payment will be made, at what time it should be made, etc. etc. So what happened? A transaction called as gratuity, now they are making a significant shift in the way they want to accept it. So this is not a change in policy. This is actually bringing in a policy. So therefore, do not consider this as change in accounting policy. The second one, if we are introducing an accounting policy, do not consider that as a change. Policy was not at all there. You are introducing it. Then don't consider that as change in accounting policy. Okay, so policy was not at all there. You introduce it now. No change in accounting policy. Okay, so this is how you have to consider the change in accounting policy mindset. So this is the overall coverage of AS5. So how ordinary item will come into the effect? Ordinary item, normal day-to-day activity, no need for a disclosure. But if nature, timing and extent of certain elements is different, the size, amount and all, at that time it's an exceptional item, disclosure is needed. But in the exam you have to write a note saying that according to company law, this exceptional item effect is not there in the current situation, but disclosure might be needed and sufficient. Then extraordinary item do not occur in normal course, separate line item in P&L and a separate disclosure is needed for financial statements. Then prior period item Basically, it is error or omission in the previous years. A separate disclosure is needed. Change in estimate, where original changes are taking place, you have to make the changes in the same place, and disclosure if it is significant. Policy only allowed if 3 points are covered, and later disclosure is compulsory. Changing the way a transaction is considered as well as introducing a new policy is not considered as change in accounting policy. So this is the end of theory of AS5. Now let's quickly go towards a problem based on this. This has been taken from your RTP. Let's see now. The accountant of Virush Limited has sought your opinion whether the following transactions will be treated as change in accounting policy or not for the year ended 31st March 2020. Please advise him in the following situation in accordance with provisions of relevant accounting standard. Now, before I start, if any AS5 question is asked to you, it will revolve in these 5 points. Either ordinary, extraordinary, prior period, change in estimate, change in policy. So any question is asked, you have to analyze from these 5 points only. Ordinary, what is the nature? Normal. Extraordinary, do not occur in normal course. Prior period, mistake, change in estimate. Assumed in one way, change to the other. Change in policy. So everything will revolve around these only. So if you could see here, in this question, it relates to change in policy. Okay. Now they are asking whether it is change in policy or not. Till the previous year, the machinery was depreciated on straight line basis over a period of 5 years. From the current year, useful life is changed to 3 years. So 5-year useful life got changed to 3 years now. Is it a change in policy? The answer is no. It's a change in estimate. Okay. Now you can directly just tell that it is change in estimate. If you could see institute answer, they just mentioned it is change in estimate and not change in policy. But you can add one more thing saying that this thing has been specifically said by AS10. So AS10 ka rules you can write saying that it should be reviewed every year. If any changes are made, it will be called as change in accounting estimate. Therefore, this is also considered as change in estimate. Next, introduction of a formal retirement gratuity scheme by an employer in place of ad hoc ex gratia payments. So what ad hoc ex gratia payment is? A random payment. From that random payment, you are coming into formal retirement gratuity scheme. So the way transaction is considered is totally shifted, a 180-degree shift. This is not change in accounting policy. So the way transaction shifts, once you have introduced a formal retirement scheme, if you make a changes to the scheme, it's change in policy. Because there is already a way of looking into transaction. You are only making the changes over there. But if at all you are totally differing from the transaction acceptance, then it won't be called as change in policy. It is also an introduction itself. So therefore, do not consider that as change in policy. So as I've already said, I repeat, every answer will revolve around these 5 points only. Know the rules of these 5 points, then you have to just decide under which rule it is going to come, then put it over there. Example, they say 2 stock sheets were missed in the last year financial statement. It's a prior period item. Fire arose, it's an extraordinary item. So those things will be done on a direct basis. You have to just see under which 5 points it is supposed to come. So with that, we finished the second discussion also with connection to AS5, which talks about net profit or loss for the period.